Good morning, it's Jeffrey Christian of CPM Group. It's about 9:20 in the morning here in New York on Friday the 16th of December. This will be the second to last video that we'll do in 2022. We'll do one next Tuesday, and then we're going to stop doing videos until early January. We'll still be open and working. Some of us will be taking some vacation time if we can, but we are just backing off from videos at the end of the year. I'll talk about the market outlook for precious metals at the end of this video. It's been a very interesting couple days or week, not only in precious metals, but across financial markets. We've seen some upward moves and we've seen some downward moves on Thursday and Friday. I'll get back to that. Right now, I want to talk about cryptos and their relationship with gold and silver. We've talked about this a lot in the past, so our views are pretty well known to people who listen to us or read our research. Gold and silver are tangible assets. Cryptocurrencies are not. Cryptocurrencies are intangible. They're unlimited, despite what some people say. There are promises, or they're not written promises. Oh yes, we'll limit the number of such and such cryptocurrencies that we will allow to be created. That's the same. No, it's less than as valid as the promises that central banks make that say, oh, we will limit the creation of our national currencies. With a bank, a central bank making issuing national currencies, you know who it is that you can complain to, and they're real people and they're real consequences. With cryptos, it's all anonymous. They are not tangible assets. And we've often said that they will implode. And in fact, they're imploding now. Before I get into that, we've also talked about the fact that cryptocurrencies have been relatively unimportant to the precious metals markets. There are people who will contend that there's been a tremendous amount of assets and investment interest diverted away from gold and silver, especially physical gold and silver, into the cryptocurrency space. There has been a little bit, but the cryptocurrency space has taken a minuscule amount of money out of the gold and silver markets and has taken out only really speculative people who don't necessarily think, but they just move on greed and momentum. So they've had a relatively small importance to gold and silver up until now. The stock market and the bond market, many times larger than gold and silver, and have been very strong up until this year. That's where a lot of the assets that have not gone into gold and silver have gone. The vast majority of the distraction away from gold and silver, if that's what you want to call it, has been to stocks and bonds, not to cryptocurrencies. Now, we've also said that cryptocurrencies will blow up. I think the best analogy are those internet tech stocks that came and went in the late 1990s. You know, two kids in their college dorm with a 5-page business plan saying, give me $100 million and we'll create something on the internet. And people did. This will happen. In fact, it's happening already. I'll show you some data in a second. When cryptos are completely dead, and you're seeing it already now as they're dying, that will refocus rational investors interested in tangible assets onto gold and silver. The shift in assets to gold and silver will be limited, however, for at least two reasons. There's a third reason, which is, as I just said, the amount of money that has come out of precious metals or not gone into precious metals but has gone into cryptos is a relatively small amount of money. A lot more money will come out of stocks and bonds and go into precious metals probably over the next 3 years or so, when things get nastier economically and politically. There are two other reasons why cryptos won't have a tremendous effect of refocusing and re-attracting investment assets into gold and silver. One is that a lot of the crypto investors already have lost money and will lose a lot more money. And and they'll have fewer investable assets to put into gold and silver. And they're not rational investors. They're not long-term investors. They tend to be people who, if they weren't investing in cryptos, they'd go to a casino and play a slot machine. Because if you look at the returns on cryptocurrencies and you say, where do I find returns like that? Where do I find volatility in prices like that? You see it in slot machines. Gold and silver trade like currencies, not like stocks, like currencies or US Treasuries. Cryptos trade like slot machines. Now, I talk about cryptos blowing up in the future tense, but they kind of already have. This is the value of cryptocurrencies outstanding. And you have to understand that doesn't mean that that much money has poured in. It peaked at $3 trillion last November, November 2021. It peaked at $3 trillion. That doesn't mean that $3 trillion has poured into the crypto realm. It means that the value, the ostensible market cap or value of the outstanding cryptos was $3 trillion. Very much less of that probably came into the market and bought cryptos at lower prices, which really were much, much lower until the beginning of 2021. And then they skyrocketed to 3 trillion. And they're now down to about 890 billion. Yeah. According to CoinGecko, as of the 14th of December, 2 days ago, the market cap, this chart is actually from CoinGecko, and you can see it's down here. The market cap or outstanding value, market value, nominal value of cryptocurrencies 2 days ago was 896 billion. That was down 70% from the peak of $3 trillion 13 months ago. There were 2,940 coin versions that CoinGecko was following. That was down about 40% from their peak in late 2021. It's still up from what you saw at the beginning of 2020 when there were about 10,000 cryptocurrencies coins out there. And there are 615 exchanges. And there's CoinGecko's site so you can see for yourself. So when I say that the cryptos are going to blow up in the future tense, they've already lost more than 2/3 of their value. And the rest will go away too. But it won't particularly be that good for gold and silver because rational investors have always seen cryptos as what they are, the antithesis of gold and silver. So we don't necessarily see a big issue, but there'll be a lot of things written and said about them over the course of the next couple of years. Ultimately, we do think that you will see digital national currencies. They're coming. Most central banks are working on them. Digital currencies based on a distributed ledger protocol is the kind of monetary technology or financial market technology that is coming. But the currencies that will survive in the future will be issued by national governments. So you'll know who to complain to when they go down in value. Now, gold and silver, we saw the prices come down. They've been weak over the course of most of the second half of this year. They started rising in November. We have seen gold and silver move above that low band of prices that were in effect really from like July or August until November. They are moving higher. We've seen the prices come off in the last couple of days. A lot of it's just profit taking. And again, it's not just precious metals. You saw stocks, bonds, other currencies other than the United States, commodities, all rising in value with the lower CPI figures and the FOMC meeting on Wednesday. And then yesterday and today, there's been some profit taking and some reality. Sort of the caffeine wore off, and people said, okay, we still have all of those problems that we had last Friday. We're in a little bit better shape inflation-wise. The trend toward lower inflation is in place. It's going to be very slow and process. Interest rates are, in fact, starting to slow down in their rate of increase. They probably will continue to increase in the first quarter of next year before plateauing, and they may start declining in late 2023. And that timing is integrally related to the third horseman, which is the potential for a recession. And people have been talking about the imminent arrival of a recession for several years, and they thought it was going to occur in 2022, and they thought it was going to occur in 2023. And most mainstream, rational, real economists and market analysts and central banks and central bank research departments think that there is a recession coming, but it may be late 2023, maybe the final quarter of 2023 or 2024 before we actually dip into a significant recession. We had 2 quarters of negative growth in the United States and some European countries this year, but it was very small. The National Bureau of Economic Research hasn't ruled whether or not that was an official recession. We've had very low growth in 2022. We're going to have very low growth in 2023, which is really important for Platinum Palladium, which I'll talk about in a second. But I think what you're looking at is low growth, plateauing of interest rates, and inflation coming down very slowly because of the longer term secular pressures on prices and the ongoing war in Ukraine. Over the course of 2023. So our expectation is that the gold price and silver prices will rise modestly next year. We've seen about a 14% decline in the annual average silver price 2021 over 2022. We're looking for about a 6 or 7% increase in the annual average price. But if you look at this chart, you can see, silver prices were very high from the second half of 2020 through the first half of 2021. And they started to come down. They moved into a lower trading range in the second half of 2021 into the first half of 2022. They moved into a lower range. We see them coming back up. We're not looking for $50 or $5,000 silver. We're looking for $26, $28 as a peak, at least in the first half of next year, with higher silver prices beyond 2023, probably in 2024, 2025. Similar in gold. We saw the gold price actually reach a record annual average price in 2022. The average, we still have 2 weeks to go. The average was $1,804 as of 2 days ago. And that is higher than the previous record average annual price of $1,799 last year. You can see gold prices rose sharply in the middle of 2020. They stayed high. They came down into a lower range. When Russia invaded Ukraine, they surged for a while. They've come back down into a lower range. Our expectation is that they will be slow to recover, but they will recover. We're looking for investment demand to be roughly a little bit higher next year than this year. It was this year. It's about 26, 27 million ounces this year. It might be 27, 28 million ounces next year. And we're looking for central banks to buy about as much gold next year as they did this year. And as we've said before, one of the interesting things over the last couple of years is that central banks have increased the price at which they're willing to buy. Central banks who don't have a 1 or a 3 or a 5-year investment horizon, they have an open-ended view, have been buying gold. Not all central banks, but a dozen or 2 dozen of them, more than in the past, and not throwing all of their money into gold, but some of it. Most of them still have a relatively small portion of their monetary reserves in gold, and they're not looking to have gold become their dominant monetary reserve. The one exception being Russia, because it has become a pariah state. Looking at platinum and palladium, if we can. Platinum prices, you can see here, they came down from over the course of the last decade. They spent 6 years basically between $800 and $1,000. They moved above that in early 2021, and they've come back down since then. Our expectation is that the platinum price will rise. It will rise in 2023, and it will rise more sharply at some point in the future when the auto industry recovers. And that may be delayed by the oncoming future recession. Palladium prices actually rose from 2016 to 2021, 2022. And that has ended. And you can really see, there was a spike higher when Russia invaded Ukraine. But the peak, you could argue, was in early 2021. And the palladium prices come down. There are three big factors affecting platinum and palladium, and they all relate to the auto industry. The first one is that the auto industry globally is suffering. It's been suffering since 2019, 2020, 2021, the pandemic, the lockdown, the recession, the recovery, the supply chain issues, all have had a negative effect on the auto industry, which is the major user of platinum, palladium, and rhodium. The second thing is that electric vehicles continue to take market share. They're probably up around 8 or 10% of light-duty vehicle production and sales in 2022. And that has reduced the number of petroleum product fueled vehicles being made, and thus a need for platinum, palladium, and rhodium for the auto catalysts to clean up that exhaust. So there is a significant portion of their main market that has been going away. The third factor is that within that complex of an auto industry and a petroleum-powered auto industry under significant long-term semi-permanent changes, you've seen a shift away from using so much palladium to using more platinum. It's not, we're not going to use palladium. We're going to use less palladium and more platinum relative to each other. And because of that, we see the platinum price being stronger going forward than we do the palladium price. Palladium price has already fallen. It probably could fall further. If investors bail out because they have a lot of palladium that they bought really starting in the early aughties, but obviously here you can see very intense since 2017, then the palladium price could be weaker. But the platinum price probably will be stronger. Because while electric vehicles are taking market share, a realistic expectation is that 10 years from now, 30 years from now, the world will still be using more petroleum than it is today. And petroleum products will be the major source of energy for the world. That's not my opinion. That's the opinion of the International Energy Agency, which are the smartest guys in the market. So you're still going to be burning petroleum in vehicles 30 years from now. You're still going to need platinum, palladium, and rhodium to clean up that exhaust. But as long as the price of platinum stays below the price of palladium, platinum will outperform palladium going forward. At some point, platinum probably will turn to a premium to palladium, and you could see some substitution back toward more palladium. But that is not going to happen in 2023. That's what we've got. I'll talk to you next Tuesday. We'll wrap up the year. You can go to our website. You can read free reads and other things. Take care of yourself. Have a good weekend. Be good to the world and be good to the people around you. They all need your love.